inflation remaining stubbornly high in South Africa. Remember, it peaked in July last year at 7.8%, but then didn't move very far down since then. The high price rises have led to a run of interest rate hikes, as I said, by the Reserve Bank. Professor Raymond Parsons from the Northwest University Business School joins us now. Prof, thanks very much for talking to us. Let's start with food inflation. For many, that's become unbearable, and it's not just the poor. We understand that food prices globally are easing, but you know, you look at that index today, you wonder, why is this going higher? Are producers passing on higher costs to consumers? Is it because of power cuts? Is that part of the reason? What's the reason for food prices being so high at the moment?
Well, good evening to you, and I think you've summed it up well. But let me pick up the point and say, yes, clearly the main culprit in the latest food inflation bad news and the CPI bad news is, of course, food prices. And they've played a big part in the fact that, contrary to the market expectations, we saw an increase in the CPI, whereas many people were expecting that perhaps we'd see the rate of inflation beginning to decline. I think there are a number of factors, but the most important factor, I think, all economic roads now lead through the Eskom crisis. If we unpack that, there's no doubt that what the Reserve Bank said at its last monetary policy meeting on the impact of what's been happening on inflation and on food prices and on other costs on the one hand, and the price that we've paid on the growth front puts us into a very serious dilemma. And that is why it seems very likely that if we look at what's happened in the fourth quarter of last year and the first quarter of this year, the economic data is telling us we seem to be heading for a technical recession. And in that bad news, of course, lies the issue of food prices and inflation. So it's really not a space that we want to be in, but it's a space that we're going to have to deal with.
Yeah, and it's very difficult to find or look forward to some sort of a solution here, especially when you look at that food basket, right? Because most food components are up by double digits compared to a year ago. You have bread and cereals up 20%, so is the case with vegetables. And again, I ask, you know, is it foreseeable that one can intervene and provide a solution here, or are the factors just too far out of our reach?
I think that they are very complex, and I don't think there's any immediate solution. The only good news, which might eventually trump the bad news, is that if you look at the global situation, if you look at the domestic food crops and so forth, there is the expectation that in the second half of the year, that our rate of inflation will begin slowly to decline. Now, that's been a promise that we thought might happen sooner, but I think all the indicators are, especially if we're going to go into a technical recession, there's no demand inflation behind that. So it is, both from a global and a domestic point of view, the possibility that in the second half of the year, we will see food inflation and our CPI begin to decline gradually. But as I say, that lies ahead. There's still a winter of discontent from many points of view for us to get through over the next few months.
Now, high wages also feed into higher prices, but I mean, the reverse is also true. Rising inflation also fuels calls for higher wages. That's another factor you've got to think about, especially with many of the unions in wage talks at the moment.
Yes, well, I think here too, I think one of the concerns of the Reserve Bank has been what they call the second round effects, that this price inflation, food inflation, wage inflation might translate itself into a wage price spiral. And we've seen some very stringent demands being made, not all of being met, because quite clearly the economic circumstances do call for a strong sense of discipline, both on the part of the employer and the employees. But the point I would only counsel, we mustn't just sweepingly say, well, all wage increases are bad. It's linked to productivity. And if we put more emphasis on productivity, I think we'd find we could create more of a win-win situation. So the important point here is not that all wage, if someone wants a 10% increase and their increased productivity justified, I say, give it. That's right. But I think the big problem in South Africa is that many of these wage demands are de-linked from what is happening on the productivity front. And the more we can bring it into alignment between labor and business, the better we can afford the wage increases that many people deserve.
And as I let you go, Prof, I mean, what does the Reserve Bank do when they look at this figure this evening? I mean, I know that they're more interested in what inflation does down the line, but many are saying this evening that another interest rate hike is likely, and you hate to pound down the bad news because they do see, inflation averaging out, and inflation is looked at in future. But I don't think we can avoid, as many would suggest, another rate hike coming up shortly.
Well, the next meeting of the Monetary Policy Committee is at the end of next month. Quite clearly, there will be another CPI figure, which we'll get for the month of April, and the Reserve Bank will assess what it sees as the balance of risks on the inflation front. I think some economists, even before we saw the figure today for March, were penciling in a 25 basis point increase. So it seems to me that what we saw today is probably, unless something unusual happens in the month of April, it's very likely that the Reserve Bank will still see that the balance of risks on the inflation front is on the upside. But I would say that is now the issue which I mentioned earlier, that the Reserve Bank would have to take into account that if the country is in a technical recession, you then have to explain, the onus is on the bank to then say by how much would they want to then still increase interest rates if the country is in a technical recession. So that's going to be a difficult call to make in very difficult circumstances. But I think once again, the bank will be data driven, and they will assemble all the data by the end of May that they have both on the growth front, on the employment front, and in particular for them on the inflation front, and what more can be done in terms of monetary policy. Should we put interest rates up by 50 basis points, 25 basis points, or should we pause and wait and see how the accumulated impact of our interest rate hikes over the past 18 months are beginning to play out over the next few months? So I think it's going to be a very interesting meeting of the Monetary Policy Committee at the end of next month.
Well, thanks very much indeed, Professor Raymond Parsons, there for your insights on today's consumer inflation figure.